All right, let's get started with this webinar. And like most of my life, it's not going to be very structured. The webinar is being presented by MedicareTraining101.com, which is, and I like to say it this way, powered by the Independent Life Insurance Agents Association, which is ILIAA.org. If you join as a member of one of the organizations, you will automatically be a member of the other. So you get Medicare training done by a brilliant person, and you get life training done by Nick. So the idea for this webinar was more of thinking out loud, how to save your client money using Medicare supplements, thereby hopefully gaining some trust, and then transitioning into a discussion of long-term care. My name and phone number and email address is on the screen. When we are finished with this chat or this presentation, if you'd like, go to SIMA-net.com, click on the chat tab, and we can continue this there. I want to let you know that I'm certainly not an expert in long-term care, although I do have a CLTC designation. The more I do long-term care, the more I realize I have no idea what I'm doing. And I guess that's just true of all other insurance. But for the purpose of this webinar, I put on a suit and tie so I would be professional. Anyway, so let's get started with it. And I think the first thing to do is let's talk about Medicare supplements. And I'll do this kind of briefly. You know that I'm an advocate of using something other than Plan F to differentiate yourself from other agents and to give value to your clients. So I've taken this, and I'm using California. I found a subscriber, a guy named Mike Gatorna. And as you can see, I hope you can see, he is 70 years old. The guy lives in Beverly Hills, 90210. So, boy, you see a guy's name of Mike Gatorna, you know he's got big bucks. Let's assume that he has a ARP plan right now, and he has Plan F. His Plan F plan is costing him $267.85 a month. He either went directly to ARP, or he went to an agent who said, hey, ARP is the best, let's go with it. Or he bought ARP when he was 65 years old, when it was a good deal, and hasn't touched it since then. All right, how do we differentiate ourselves? Well, we can use almost any other company down here and save the guy some serious money. So let's, just for the purpose, again, of our discussion, let's say that you want to use Anthem Blue Cross. It's $216. You've now saved him, apples to apples, $500 a year. Actually, you saved him more than that. You saved him $50 a month. You saved him $600 a year. And all he has to do is sign the piece of paper. California, we have the birthday rule, which means if he signs it within 30 days past his birthday, there's not even a medical question. It's guaranteed issue. That's a good way to gain somebody's trust. Once you've done that, and on an apples-to-apples basis, you can save him a fortune. Well, why don't we look at this plan, which is Plan N. Plan N, I won't even go into all the details on how Plan N differentiates or is different from F, but bottom line is for most people, they won't spend more than about $300 a year out-of-pocket costs for their medical care. If you look at the ARP plan at $267 and the Anthem Blue Cross plan at $144, we have a difference of $120 a month. $120 a month is $1,440 a year. You've just found this guy a ton of money, hopefully. He loves you. $1,440 savings, he's going to spend $300, let's call it $440 a year on his medical care. He just netted out a savings of $1,000. All right, so now you've got his trust. Now what we need to do is transition over to final expense. The question is then asked, what have you done about your final expense? Your need for potentially extended care, either at home or in a facility. The usual answer is, well, I've done nothing. because it's too expensive. And the guy's right. A 70-year-old to get any kind of a decent benefit is going to be spending over $3,000 a year or close to it. I don't even know what he'd be spending in California now because the lowest price carrier, Genworth, has just pulled out of the state and won't reappear for another month. The rumor has it they're going to be about a 60% more expensive. Same plan, 60% more expensive. This leads you into a discussion, well, if you're not going to buy long-term care, should you need help at home, either temporary or for any kind of extended care, or in a facility for a while, you are going to have to pay yourself. How are you going to do that? Well, Mike's got a few bucks. He's going to say, Mike Catorna's got more than a few bucks. He's going to say, because the only option at that point is to self-fund. I will be paying for this out of my savings. Well, how much in your savings do you have? Let's just assume it's a couple $100,000. You can pick a number, it doesn't matter, but let's just assume he's got a couple $100,000. So if you need care, you have a couple $100,000 that you could reasonably expect to spend. Correct? Yes. If I had to, I could spend it. It's the only money I have, but that's what it's there for. Well, let me show you what I think may be a better way, or at least certainly an option, and that would be using a product called Moneyguard. And let me digress here. I'm not trying to promote Moneyguard as the only option or the only thing that Michael should do. It is just an option for somebody who is going to self-fund their own insurance, their own long-term care benefits, as most people will be doing. Well, we have this product called Moneyguard, and what this product can do is leverage your own money so that you don't need to spend $200,000 if indeed you need long-term care. What I'm going to assume is that you are going to take $75,000 out of the bank, your left pocket, and put it in Moneyguard, and we'll call that your right pocket. And the reason we're going to call that your own pockets is that with both products, the CD or Moneyguard, anytime you want your money back, obviously you can get it. It's still your money. So in this case, a 70-year-old male is not going to get a whole big bump up in death benefit with this product. Put in $75,000 premium. As you can see on the right-hand corner of your screen, I trust the death benefit is just barely more than he's putting in. And I'm not sure if that's correct or not. It seems like this would turn this into a mech, that there's not enough death benefit, but I'm just going to go with it for now. The $75,000 will give that person a long-term care benefit of $225,000. Remember, he had $200,000 he could earmark for long-term care. Well, here we go. He's got $225,000 based upon a $75,000 movement of money from left pocket to right pocket. It's limited to $3,136 a month, so a little over $100 a day. If he used the maximum, it would last 6 years. Enhanced surrender value of $75,000 is important. The enhanced surrender value endorsement ensures the amount payable upon surrender will not be less than the sum of premiums paid, reduced, of course, for any benefits paid. And the first benefits are, of course, going to come out of the $75,000. So as you explain the concept, we can skip this page, it's not important. As you explain the concept, here's what we got. It's going to put $75,000 into the policy. The guaranteed benefit available for long-term care is $225,000. The next question might be from some agents, well, what about inflation protection? Well, there's no more inflation protection on this than there is from the CD. If he needs an extra boost, he's still got money in the bank that will pay for the potential inflation protection. This policy, if you add an inflation guard, just doesn't work very well. So he's got $225,000 he can use. He's got $3,100 a month potential for long-term care benefits, and it's just as broad as any other long-term care plan. And he has a death benefit, so if he does die, the death benefit transfers tax-free and probate-free because you have all the life insurance benefits. Here's how it looks in a graph. All right, well, he's got $200,000 of assets. He has moved $75,000 into Moneyguard. That now frees up $125,000. He has a death benefit or long-term care benefit, initial benefit of the $75,000 because that's his money that he put in. He gets an additional long-term care benefit of $150,000 for a total of $225,000 worth of long-term care. So, as it says down here, Moneyguard Reserve Plus is an intelligent way to protect your assets. By simply moving $75,000 of your assets, Moneyguard Reserve Plus provides an immediate death or long-term care benefit of $75,000 and change. This now frees up $125,000 of your assets for other use. We have added several riders to this. One is that extended long-term care benefit that adds $150,000 benefit. We've added the return of premium so that no matter what happens, anytime money is requested and we want to surrender the policy, it is surrendered for the full $75,000. So you get 3 guarantees on the product. Guarantee number 1 is you get a death benefit. Guaranteed. Not much, but it's guaranteed, and it avoids probate and taxes. Guarantee number 2 is that long-term care benefit. Guarantee number 3 is a full return of premium benefit. If anybody here has any quick questions that they want to type in the window, we can do it here. But it's probably easier to go over to the SIMA.com website chat down here, where we can discuss it a bit more. So unless somebody objects, I'm going to close this out. And as I said, this is a thinking out loud type of a deal. It was not structured, except for the fact that I'm wearing a suit and tie. I'd love to have clients, more clients like this Michael Gatorna, who have money and would understand this. So anyway, let me say goodbye on the chat, and I'll figure out how to close this because I'm not sure. And I'll see you guys hopefully over at SIMA in just a couple minutes. Anyway, thanks for being here, and I'll talk to you guys in a few minutes.